Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 228, Understanding Bonds. Cory, thank you for joining back on another episode.
My pleasure, Jake. Thanks for having me.
And thank you to all of our subscribers. Our subscriber count continues to grow. So if you're listening to this on your favorite podcast platform, whether that be through Apple or Spotify, thank you. If you're watching this on YouTube, thank you as well. It's pretty neat, Cory. We're hitting those triple digits pretty consistently now as far as views on YouTube. So again, subscribe, thumbs up, 5 stars, whatever you want to do, share our content. We're here ultimately to enhance your financial literacy and that of our clients and basically anybody out there consuming our content. Cory, before we go over the wonderful world of bonds, I want to check in with you. What's new? Is anything going on? It's a Happy New Year, by the way.
Thank you. Happy New Year to you. That's the biggest change around here, I think. At least I think that's probably the case for all of us here into a new year. But this year I feel excited and enthusiastic about the year ahead. Not too much new going on, but looking forward to, again, a fresh start here.
So Rachel and I, we kind of went through a tentative vacation deal. Do you and Cassie do that?
We do. We admittedly, we didn't probably put as much structure around it for 2023 as I intended to last year, but we kind of have a general idea of the things that we want to do this year and when we want to do them, but we probably
Where are you going?
More committed to scheduling it out. So in the month of April, we're going to Sedona, Arizona, which we're excited for. I haven't been there before. I have a group of, there's I think 4 or 5 other couples we're going with. So that'll be a lot of fun. And it's a group of guys I went to high school with, actually, and their spouses. But at this point, I think that's the only thing that we have booked, but we've got a few other things in mind. How about you guys?
Yeah, thank you. And so I think we love going to New York. So we're probably going to go to a Broadway show in New York sometime in the spring. I play a lot of golf, so we're probably going to make some trips down to Tulsa to play golf there. I've got a trip I think I'm going to go on in San Antonio to play golf on. That's all kind of coming up here soon. We would love to book a big trip. So we're thinking France and maybe the Netherlands. It's the Netherlands, right? And Brussels, all right in there. Mm-hmm. So we're thinking that. We haven't booked anything yet, but that's kind of what's on our radar for 23, along with, again, some regional things. Probably go down to Texas, see my parents, and do some of that fun stuff. So yeah, we're just gearing up. It's kind of exciting to plan and think about it, and then start getting things booked and off we're rolling. It's been a mild winter in Kansas City. I know we had that cold spell, but it's pretty interesting. It's confusing me a little bit because I don't know if I should start golf back up or do I still keep hibernating and wait and give it another couple months. I don't know. But I'm
don't let the Midwest weather fool you, Jake. It will be cold soon.
Funny? Everybody says that. The weather always changes in Texas. The weather always changes in New York. The weather always changes in the Midwest. I think it's funny. People always think that their geographical location, their weather is the craziest.
I'm all but certain that it's early for you to fire the golf back up, but that's just my opinion.
Yeah, you're probably right. And so I'll keep hibernating. This is the time of year that I work a ton. So it's been a lot of fun meeting with current clients. We certainly did a lot of tax planning at the end of the year for our clients. Now that we kick off the new year, just continuing with our normal review cycles with our clients and then meeting with a ton of new clients. So that's been a lot of fun. I know you and I both enjoy meeting new people and getting people to join our practice so that we can offer our services to them. Okay, good. So that's enough about that. But today we wanted to talk about understanding bonds. So again, in the last episode of Upticks, episode 227, if you haven't checked that out, we talked all about stocks. So today we want to talk about bonds. And first, Cory, I want to define exactly what a bond is. And the simplest way to understand a bond is to think of it as a loan. So just like we talked about a stock being an ownership stake in a company, In this example of a bond, you're instead of owning a company, you're loaning money to a company. Okay. And so what normally happens is you will loan money for a $5,000, $50,000, $100,000, whatever it is, dollars to a company, and they will agree to pay you interest, just like when you and I borrow money, Cory, we have to pay interest on that, but they will pay you interest. And then after a predetermined time frame, 1 year, 5 years, 30 years, you can expect to get your principal paid back to you or your original investment as long as that company is in business. So that is loosely what a bond is. Just think of it as a loan. So instead of you borrowing the money, you now become the lender. Okay, so that's a bond, loosely defined. That's what it is. And Cory, why don't you kind of lead us into our second point about bonds here? I don't want to take too much of it over.
Sure. No, absolutely. So when we move past what a bond is, there's a lot of different types of bonds, just like you've highlighted, Jake. There's corporate bonds, which you just described. It's when a company issues that loan. You're effectively the lender, and you're earning an interest rate along the way for owning it. But there's also, government or sovereign bonds, which the United States Treasury is a perfect example. And governments around the world issue bonds to fund government spending, to pay down debt, to raise capital, whatever it might be. There's also municipal bonds that are typically issued by municipalities. Think, Jackson County, Missouri, for example, if they wanted to revamp the sewer system, just making up an example, they may, ultimately, there may be taxpayers that vote on a bond issuance. But the whole idea with the municipal bonds is that you are lending money to a municipality. And those typically have some tax advantages around them, not all the time, but oftentimes when we buy them for clients, they do. But I don't want to get ahead of myself. And then there's also high yield or junk bonds, which we generally shy away from at Falcon Wealth Advisors for our clients. But high yield or junk bonds are very similar to investment grade corporate bonds in that they're issued by a company. However, a corporate bond, whether it's investment grade or high yield, depends entirely upon its credit rating and the likelihood of how long the business will stay in business.
Got it. Yeah. So you got a little bit ahead there, Cory. But yeah, broadly speaking, corporate bonds are issued typically by publicly traded companies. You've got government bonds issued by the United States government or China or wherever who's issuing the bond. And then municipalities you can think of as the state and local level as far as that's concerned. So there's various types of bonds. It's a whole market in and of itself. In my opinion, it can be just as robust as the stock market. And so it's not something that you certainly want to do on your own. I think it pays to have a licensed professional who understands the bond market and knows all the intricacies that go into buying or selling a bond. Now, I want to talk about, Cory, as our next step here, or why do we use bonds, right? And typically some of the characteristics of the bonds that we use are typically, not always, but typically safer than stocks because we buy what you mentioned are investment grade bonds. So ideally, we're taking a little bit less risk, and in return, we're getting some sort of predictable cash flow. So we really like bonds in a well-diversified portfolio to lower that risk profile and generate some income for our clients. Most of our clients, not all of them, but most of them are already in that high net worth sector, meaning their net worth is 1 million or above. And so they're not trying to roll the dice here and put all their money in a bunch of risky assets in the hope that they'll triple their money. Really what they're looking for is protection, growth of their capital, and some sort of steady cash flow. And so we like bonds because we feel like it counterbalances some risk that you take in the stock market. It provides a somewhat predictable cash flow for our clients, particularly if they're retired. It's a good perk to have in retirement. And that's why we like it, to counterbalance. Now, again, you have to be careful because just buying a bond in itself doesn't mean it'll have those characteristics. That's, again, one of the reasons that our clients hire us at Falcon Wealth Advisors. But generally speaking, we like bonds because, again, it's typically can be a little bit more stable and it offers some diversification to stocks. Cory, why don't you talk about a little bit about how we go about buying bonds? Like literally, what goes into making a bond transaction?
Sure. So we do buy individual bonds for our clients. So we're not pooling money together. in some type of investment product. We're actually going and buying the individual bond. Now, what's unique and interesting about the bond market, and you alluded to this just a moment ago, Jake, it's huge, quite a bit larger than the equity market. So the global bond market is far and away the largest market that there is. So when it comes to the actual transaction itself, there's numerous different places where you can ultimately execute a bond trade. Oftentimes, our investment management team will quite literally, if they're going to buy a bond, they'll either do so through Charles Schwab, which is the primary custodian where our clients' assets are held. But we also have an arrangement where we have really the bond universe in its, in the aggregate for the most part, available to us outside of just what is inside of Charles Schwab's inventory. So our investment management team can use Bloomberg, one of the investment research tools that we've invested in at Falcon Wealth Advisors, to find the best prices for clients at institutions all over the place. So ultimately, we have the bond market available to us, and we can execute those trades and allocate them to individual client accounts so they can begin collecting the interest that those bonds pay.
Very good. Yeah, thank you, Cory. So you're right. So we could either go through our custodian, go out in the open marketplace, which is really neat. And that's actually when we can shop prices and look for the best deal for our clients. And as fiduciaries, again, we want to act in the best interest of our clients, but also we're not charging any type of markup on these bonds. A lot of brokers out there will buy a bond and then they'll literally mark up the price. And so their actual client will have to pay more than what that broker paid for a bond. And it's not necessarily a bad thing, but I just want to make it clear that that's not what we do at Falcon Wealth Advisors. We feel that that creates an unnecessary conflict of interest. And so for us, Cory, we get paid the same whether we buy a stock or a bond for our client. It doesn't matter. There's no influence on our compensation. Really, we're doing what we think aligns with our clients' financial plans and what aligns with their goals and objectives and their risk profile. And so, but I think it's important because not all advisors do it that way. Some advisors, again, so, they may have bought the bond for $100, but the client has to pay $102. And the client, sadly, doesn't always know this, which is I think it's a large shadow in the investment management industry. I think it should be more transparent, but that's a topic probably for another show. But just know your team at Falcon Wealth Advisors, we're not adding these markups to our bonds. We're literally just going out there and buying them in the open marketplace, and then they're included in the assets that we manage for our clients. But that's good, Cory. So again, we can leverage our back office Hightower. We've got Charles Schwab that we can buy. So there's literally bond desks out there that help our trading group, and that would be Connor, Matthew, and Abby, execute these bond purchases on behalf of our clients. So they're just like they're monitoring the stock market every day, Cory, they're monitoring the bond market every day. And if a client has cash that's been built up, or maybe a bond has matured and they've gotten their principal back, or maybe it's just time to rebalance, they're going and making these transactions on a discretionary basis on behalf of our clients, which is really neat. Now, a strategy, the way that we buy, so we talked about how we literally go about doing it, but the way that we feel is best to manage a bond portfolio is to do something called laddering the maturities. And this literally looks like rungs on a ladder. And so you could have a variety of different length of ladders, but to keep it simple, Cory, we'll just use a 5-year ladder for today's purposes. So if you have $500,000 allocated in your portfolio that we want to buy bonds with, in this example, and this is only again for illustrative purposes, we would theoretically buy a bond that matures or means you get your money paid back to you in 1 year for $100,000, a bond that matures in 2 years for $100,000, a bond that matures in 3 years, and so forth, all the way up to 5 years. So you have $500,000, each $100,000 rung on the ladder. They all mature at different times, and more than likely, they're all going to pay you different interest payments. And an old colleague at one of our former firms, Cory, always said this to us, and I loved it. And he said, when you buy the ladder, rates don't matter. And so what's designed is that if you have a rising interest rate environment, which is we've certainly been in, the last year, well, we have bonds that are maturing for our clients, so they're reinvesting their cash into new bonds that are hopefully paying higher interest than what their old bonds were paying. And if rates are declining, well, the good news is now you'll have some bonds that are already invested that are already paying you interest, so the declining rate doesn't impact your bond portfolio too much as well. So again, just like the stock market, there's no perfect way, but we like a laddering strategy. And today we're doing a 10-year ladder, Cory. And I know you've been involved in our bond research more so until we hired Connor, our chartered financial analyst. But why don't you talk about why we've lengthened the bond ladder, since it is a little bit pertinent as we head into 2023 here?
Absolutely. So in the calendar year 2022, we lengthened the bond ladder out to 10 years, like you just spoke of, Jake. And the reason we did that is because we've seen interest rates move up meaningfully. There's certainly no way to know. You and I, Jake, can't predict the future by any means, nor can anyone else for that matter. But I do think that we certainly have recognized and have listened to what the Federal Reserve, who controls short-term interest rates, has said. And with a big move in interest rates that's already occurred, it has made longer dated bonds, let's say bonds that mature in 5 to 10 years, much more attractive than they were 1 or 2 or 3 years ago. So the idea is, if we're buying bonds that mature in 8, 9, or 10 years, and we can earn 4 to 6% as an interest rate on those bonds, we're okay with that, because a couple of years ago that interest rate was meaningfully lower, and that's why we had the bond ladder shorter at the beginning of 2022, because we expected interest rates to move higher.
Right. So that's great. So what we're doing now, because we've lengthened that ladder, we are locking in rates, hopefully for a longer time frame. Now, like you said, we don't know if rates are going to go up or down. They're probably going to inch up a little bit higher. But the way we look at it is, if we can buy a bond and it's paying 4, 5, 6%, that's not such a bad return to invest in for our clients. Now, I haven't spoken about this, and for our last topic here, I want to go into the risk, Cory. But before that, I want to talk about how we determine a bond allocation for a client. And I think I've alluded to this on our last episode, but the whole idea is, any money that we feel that a client is going to need to access within the next 5 years at a minimum, 10 years ideally, but 5 years at a minimum, we like to put in this bond cash allocation. And the idea is, we have a somewhat predictable cash flow schedule. There typically is lower volatility, and it allows us to not have to worry about the day-to-day variations of the stock market to fund our clients' cash flow needs, right? So if a client's certainly working and projects to work for several more years or decades, then their bond allocation is probably quite a bit lower than somebody that is in retirement, and maybe they're pulling $5,000 or $10,000 a month from their portfolio. So ideally, again, we like to have at least 5 years worth of money in these bonds. They're generating interest. The clients are living off that interest. If they need to sell a bond, or maybe a bond's going to mature every year, so they can have that predictable cash flow coming in. But I think that's very critical and very important for clients to understand. That's why we feel like bonds can make up a good portion of their portfolio sometimes, because again, we want to have 5 to 10 years worth of money in that bond portfolio to, again, help with that portfolio construction. And again, this is another reason that clients don't want to get caught up in the hysteria of the stock market, because if you have 5 to 10 years worth of money in bonds, in their government bonds or municipal bonds or highly rated corporate bonds, Cory, that should provide some level of calmness over your portfolio, because I know the media likes to pump on that stock market and it crashing or rallying and everything else going on. So that is very important to us. The way that we build portfolios, we take seriously, and this bond component is very important. Okay, good. So Cory, why don't you kind of segue us into our last topic on bonds today, and that's going over risks, because there aren't, this isn't a riskless trade, right? There is still opportunity for you to potentially lose all of your money in bonds. So Cory, why don't you go over some of the risk parameters that are out there and things that we look at?
Okay, perfect, Jake. And I have a few different risks that I want to highlight here. Do you want me to just rattle through them, and then we can have a conversation if necessary? Do you want me to kind of pause and talk about them in between?
Yeah, rattle through them. Let's
rattle through. Okay, good. So when it comes to the risks associated with bonds, the first risk is called interest rate risk. And interest rate risk is basically the potential for a bond's value to fall in the secondary market. So if a client owns a bond in their account, it falls in price because there's competition from newer bonds paying more attractive interest rates. This kind of goes back to the bond laddering example that you talked about earlier. Bonds value can move up or down based upon what prevailing interest rates in the market are doing, but one risk associated with them is interest rates. If interest rates move higher, bonds will move down in price Of course, if they're held until their maturity, the principal would be returned and you'll still collect your interest payment along the way. The next risk is called reinvestment risk. And that's the possibility that a bond's cash flow will go into a new bond at maturity that's paying less interest. Perfect example of this, Jake, would be if we owned a 10-year bond ladder and interest rates declined over the next several years. As the bonds that are maybe paying 4 or 5% today mature, if they're reinvested into bonds paying 2 or 3% because interest rates are lower, that's reinvestment risk.
Yeah, but that's also one of the reasons that we do the ladder, obviously, right?
Correct.
So again, you can't fully eliminate reinvestment risk, but a good point here is if you put all of your bond portfolio in one bond that was going to mature in 3 years, then in my opinion, your reinvestment risk would be much higher than somebody that laddered their bonds.
Yep.
And you're right, interest rate risk, you're right. When you buy a bond, interest rates could go up or down. That's just part of it. Okay, good. Let's keep your rattles are a little longer. Let's keep going here.
Rattle quicker. All right. Next rattle is called default risk. That's the chance that the issuer may not be able to meet its financial obligations or goes default. This would be prevalent. Well, really, it's prevalent in any type of bond. Certain bonds, it's going to be much more prevalent than others. But the idea is, Jake, if you and I are the lender to an institution, to a corporation, to the government, we're relying upon that institution or entity to be solvent upon the bond's maturity so the principal is returned to us. In other words, if somebody owns a bond in a company that goes bankrupt or goes belly up, the likelihood of them getting all of their capital returned to them may be much lower.
Yeah, so you're right. And that's what you were alluding to in the beginning with a junk bond versus an investment grade bond. And so there are rating agencies out there. Now, again, they're not perfect, but they're at least it's some sort of guideline that will rate these bonds. And they'll say, hey, we think that there's a high probability that this bond will be able to meet its financial obligation, or there's a low probability that this bond will be able to meet its financial obligation. And that's something that our team, our investment management group, again, it's comprised of Connor, Matthew, and Abby, they're looking at those ratings when they're determining which bonds to buy for our clients' portfolios. And Connor, being a chartered financial analyst, can even go deeper into the financials and look at a bond and its cash flows and operational costs and all those things for the company to make sure that he feels confident in putting that in a client's portfolio. And so that's why you have to be careful, because I think, Cory, a do-it-yourselfer, if they're just going out there and looking at the bond market, they may just go pick whatever bond's yielding the most interest. And you have to be careful, because if a bond is yielding 10%, for example, that probably means there's a higher level of risk there. And you have to be careful because they may not be able to fulfill their obligations. So even though it looks good on paper, like, hey, Cory, I'm going to get 10% of this bond, go buy me that one. Yeah. Well, you have to peel back that onion and say, well, wait a minute, why is it paying 10%? And also, you always got to remember, if it sounds too good to be true, it probably, isn't true. So good. What else do you have for risks? Those are good. So you got the interest rate risk, reinvestment risk, you got default risk. What else you got?
The last one that I have that I wanted to highlight is inflation risk. And that's the possibility that inflation will erode the value of a fixed price bond.
Yeah. Oh, look at that. That was rattled. Very good
rattled.
There. So you're right. And that's why you have to be careful. And that's why we typically also don't advise clients to put all their money in bonds. Because you're right. Let's say a client's target rate of return is 6%, Cory, and I can get them 6% in a bond. The argument would be like, Jake, just go buy me bonds. If you're telling me that there could be less risk there than stocks, why am I messing around with the stock market? Well, you're right, Cory. If inflation kicks up like it has, these bonds don't always appreciate. And that's why we like to have some sort of capital appreciation exposure in a portfolio. And typically, we like stocks for that capital appreciation exposure. So again, bonds aren't typically going to appreciate because of inflation, meaning if you put $10,000 in a bond and it matures in 10 years, you're going to get $10,000 back. You're not going to get $10,000 plus inflation. Now, you will make some sort of interest, hopefully, along the way, but that $10,000 is not going to grow typically in value. So very good, Cory. I like those risks that you had teed up for us today in there. So again, big takeaway, our bonds are a huge market, like Cory pointed out. There's a lot that goes into managing a bond portfolio. Our team, again, we take it very seriously. We are buying individual bonds directly for each and every client at Falcon Wealth Advisors. So we're not doing some pooled investment. We didn't even go into bond funds, Cory. But again, quick side note, why we don't use bond funds is a big one is if you're pooled in with other clients, and own bonds. And if interest rates go up and bond prices go down and other individuals in that pool start selling bonds, well, now they're locking in losses, and that can be very detrimental. So again, we don't like bond funds, don't like bond ETFs or index funds because of that. And that's another quick tangent here, but I think this is very important that clients understand too, is that even though a bond may fluctuate in value, Cory, and maybe you can add on to this, as long as that bond remains solvent and over the predetermined time frame, let's say it's 5 years from now, you can expect to get what's called the face value paid back to you. So the $10,000. So even though a bond may be showing up in your portfolio that's only worth $9,000 today, if the face amount is $10,000 and you hold it to maturity, you'll get $10,000 as long as that bond, again, that company stays in business. So I think that's another big misconception that people don't always understand with bonds. Cory, did I miss anything on that definition there or explanation?
No, I think you explained it well, but I do think that it speaks to some of the confusion, frankly, that sometimes people have. I find it amazing, Jake. Sometimes I will meet with clients and some people will have the perception that it's a great time to invest in bonds. And then other people will have the perception that it's a horrible time to invest in bonds, because there's a relationship between interest rates and bond prices, duration, right, of the bond ladder, like you talked about, Jake. There's so many factors that can influence it. But the fact of the matter is, it really comes down to the unique individual and their unique individual financial plan.
Right. Good point, Cory. And it is fascinating. If rates go up, bond prices go down. And when rates go down, bond prices go up. So it is something that we have to juggle and that we're always monitoring and paying very close attention to. But again, the good news is if you don't buy bond funds, you can have a bespoke, how about that one, Cory? A bespoke bond portfolio. And we can literally go through it bond by bond if you like and explain each bond, why it's in the portfolio, what's its maturity date, what interest are you collecting, and we can really dive deep into that portfolio for you. And that's one of the perks, again, of working with someone that's buying you individual investments directly. You have that level of transparency and control when you're doing it that way.
Very good. Let me add just one more real quick thing here, Jake, at the very end, just in summary, because I know a lot more people have been thinking about, talking about, paying attention to the bond market, frankly, over the course of the last year, because rates have moved up quickly. What I want to point out, and that, of course, has a lot of ripple effects. It's a big contributor to all the volatility that we saw in the market in 2022. But one thing that I want to point out, and I'm sure you've been highlighting this with clients, Jake, the same way that I have, because of the steps we've taken, the way that we've approached how we manage the bond portfolio, the biggest upshot of what's materialized in the last 12 months is, like we described earlier, our clients that own bonds that are maturing today or tomorrow or this year that we may have bought a few years ago, we're able to reinvest into new bonds paying a lot more interest. So from my perspective, for someone who's retired or retiring very soon, the fact of the matter is higher interest rates mean more income that the portfolio can generate on the bond side of the portfolio, and that is not a bad thing.
Right. That makes the heavy lifting on the stock part less heavy, because again, like I commented earlier, if you can get 4, 5, 6% in a bond, not necessarily a bad thing at all, especially for someone in retirement or approaching retirement. Very good. Well, thank you again, Cory. That is all the time that we do have for you today. As always, thank you all for tuning in. If you have any questions, you can simply email me at jake@falconwealthadvisors.com. Cory is Cory@falconwealthadvisors.com. That's CORY. Thank you again. Happy New Year. We really enjoy cranking out these episodes. So again, if you have any show topic ideas or guests you'd like us to bring on, please don't hesitate to do so. And thank you again, and we hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.